last week was notable because the Federal Reserve met and had its FOMC meeting, delivering the 25 basis points rate cut that the market was expecting, and thus squarely putting the federal funds rate between 3.5% to 3.75%. What was more interesting was not the rate cut, but that the Federal Reserve is signaling that it is done with its insurance rate cut for now. Q3 GDP now is revised to 3.5%. Juxtapose that with the labor market that still is showing signs of weakness. Now, tomorrow or Tuesday is of importance for this week because non-farm payroll numbers will be released, giving us a better insight into how the job market is doing. The Federal Reserve is now taking a hawkish stand, believing that they are close to a neutral interest rate and that the interest rate currently is not too restrictive for growth. Where we are sitting in the overall global economy is a really mixed, uneven global policy. For Bank of Japan, for example, is meeting this week to raise interest rate to 0.75%. Now, this is a seismic shift, if you guys remember where Japan has been in its economic history. So a rate rise or rate increase, big deal in Japan. Second, the Bank of England meets for a rate cut this week, followed by ECB. That's probably going to leave rates as it is. That's what is happening on the global market while the Federal Reserve keeps rate probably on a hold for 2026. The market's still anticipating a rate cut in January of 2026, but let's see how the payroll data plays out for this week. The market's focus is turning to the rising U.S. deficit. And for this year, the U.S. deficit, 12-month deficit, is ending at 5.27% of GDP. Now, this is interesting, and it's a psychological number. For 2026, for the first time in a while, U.S. deficit to GDP number tracks under 5%, which is an important debt metric. However, the market will be focused on U.S. deficit, and that is what will cause the yield curve on the long end to either get steeper or react. The short end is controlled by the Federal Reserve and the long end is controlled by the market. That is weighed down by worries like U.S. deficit. So that should be interesting as the year closes and that worry comes back into the picture.